Without further ado,
works, and also, more importantly, to debunk some of the myths that are out there where reverse mortgages are concerned. I work for Bay Equity. We are a direct lender, and one of the many products that we offer is reverse mortgages. One of the things that these are details here, so I'm gonna just go on and kind of talk about first the myths, okay? Because as you know, reverse mortgage, we have to be at least 62 years of age or older. And it's something that many people think when they see the Tom Selleck commercial, they think, oh, I might qualify for that. That sounds great. That sounds like a possibility for me. Maybe my home can now turn into a reverse mortgage, and on my fixed income, I will no longer have to worry about making that monthly payment anymore, because now my income is going to go fixed because I'm planning on retiring. Many people are looking at their two-story home and they're thinking, gosh, this home is just too big and too difficult for me to handle anymore. Wouldn't it be something if I could sell this and buy something that's a single story that would make more sense for me now that I'm going into retirement? So many people are fearful of how a reverse mortgage works because they think when they talk to their family members or their friends that a reverse mortgage may hinder their future heirs. That if they're 63, 64 years old and they're getting a reverse mortgage, that down the line 20 years from now, when they go on to the next place and they pass, what will they leave for their heirs? Will they leave debt for their heirs? Is this something that their heirs are going to have to take on and it will be a burden for them? Where is that going to fall in their lives? How will that affect them? Well, the reality is that a reverse mortgage is not geared to cause hardship to people. To the contrary, it's geared to help people survive and continue living the life that they choose to live into their retirement. So there's many things about a reverse mortgage that I'm going to tell you right now that are key. You need to have about 50% equity when you're going into the home. That's the goal. Why? Because we have a life expectancy that we calculate as to how long you're going to live, and we need to be able to cover those payments with the equity that you have in the home. So on a reverse mortgage, it's reverse from a forward paying mortgage. Today, right now, while we're working and we have our 40-hour-a-week job, we're set. We've budgeted for our monthly payment for the maintenance, property taxes and insurance, and we're good to go each month with what we earn. But as we approach retirement age, we know that our income is going to decrease substantially. So part of the planning that one does is decides, is this house still going to work for me? Is this home that we live in right now going to work for us in 10 years when we're 72 or 75? Am I going to be able to climb the stairs in 10 years? Or is that arthritis starting to get me, or are my knees starting to bug me from all the jogging that I've done over the years? We need to think about that and plan ahead before you actually hit that button and say, I'm done, I'm retiring. So part of the planning process is considering those things that I've mentioned. And how will this work for me? Well, Miguel, your real estate expert, can tell you how much equity you have in your existing home and how much equity you can pull out of it. That's one. Then Nuri, our accountant expert, can tell you what the benefit will be if you go from your bigger house to your smaller house that's now not two-story but single-story. And then I will tell you how much house you can buy. So part of our goal here is to be a team for people who are considering reverse mortgages and guide you and let you know what your best options are in terms of numbers, in terms of figures. Okay? Reverse mortgage will cover your home purchase. Say you buy a house. Say the house costs $400,000. It's that single story, 2-bedroom, 1 bath that will work perfectly for you and your husband. It's perfect. You no longer have the 5-bedroom, 3-bath house. Now you have this 2-bedroom, 1 bath house, and it's going to work out into your retirement years. So how's that gonna work? Okay, well, the house costs $400,000. I'm gonna put $200,000 down with the equity from my home that I just sold with Miguel. And I'm gonna have another $100,000 left over that I can use and just set aside in savings and not worry about it. My $200,000 on my reverse mortgage, how does that work? How is my payment calculated? You say I don't have a payment, but nothing is for free. This is true. A reverse mortgage is an FHA, HUD insured mortgage, okay, which means it's a guaranteed loan, okay? They're not gonna come back down the line and say, hey, you need to leave your house because now you have surpassed the value of your home in terms of the payments that have accumulated. You're gonna have to leave your home now, so we're gonna kick you out. Or when you die and your children notify the bank that you have passed and they're told, okay, well, you need to sell the home. It's not gonna be, oh, you need to sell the home and now, by the way, you need to take on this debt that has accumulated. You need to take on this burden. That is not the case, okay? So the beauty of the reverse mortgage is it affords you your independence. It allows you to continue living in the home in the future with your money that you've saved, with some of the equity that you got from selling the larger home that you no longer needed. That can go towards in-home health care in later years that we might need, which a lot of us, eventually we do need help. We do need some care when we get into our 80s or 90s because we don't want to live with our kids. We still want to be in our home. We want to be independent, but we need help. So planning ahead for something like this is the way to go. Reverse mortgage will give you that peace of mind. It will afford you the ability to have more disposable income monthly so that you can continue doing what you enjoy doing. If it's, going on small little short trips to Las Vegas or going and visiting your grandkids in Arizona, you will have the ability to do it because you will not be tied to your home and having to make that payment. You will now be able to enjoy your retirement with peace of mind. So that's my spiel
I
on
have a
it.
question for you.
Question?
Does the bank ever own the property?
Bank never owns the property. Property is always deeded to the buyers. John and Jan Smith, always. Question?
So if I change my mind later on and I said I want my house back, meaning like I want to pay off the loan, is there prepaid penalties? Is there any changes on?
No prepaid penalty.
No prepaid penalty, okay.
No prepaid penalty. It's just like any loan that you deem that you're ready to pay off. You
Okay.
can go in, get your payoff amount, just like you would a car when you're ready to pay it off early. They give you that amount and you pay it off. No prepayment penalty and no pre-existing issues with regard to, no, this home belongs to the government, not you. It's always in your name.
So it means you can sell it
Correct.
anytime you want.
Yes, sir. Yeah. Question?
Is there a maximum amount of property that you're allowed to buy under this arrangement?
Well, typically, you need to have at least your 50% down payment.
Yeah, but what if it's like close to $1 million?
Well,
I'm not really downsizing, but I want to go up there
you can
and
go,
not sell my property.
you can go
I
up,
can,
you can go up. We adhere to FHA loan limits. So you figure if you have 50% on a $1 million property,
yes.
you're at 500,000.
Yeah.
You would be
I can do
okay.
that. So I'll just be paying the other half. And,
It accumulates in the
Right.
background to your principal
Right.
balance.
When
That
does
is
the
correct.
reverse mortgage come in? The picture?
The reverse mortgage is
Correct.
introduced at the very beginning when you purchase.
Uh-huh.
So before you're actually going out and looking at the homes, you're figuring out how much money you have. And at that point, we introduce a proposal to you and tell you this is how much home you can afford. So if you have $500,000,
Right.
goes based on age, life expectancy, and so on, we present to you the maximum home that you can purchase via a reverse mortgage.
Depending upon my income, of course, capacity to pay.
Well, no, actually, your capacity to pay is no longer calculated into this, and I don't want to refer to it as a no-doc loan, because it's not, or a no-income loan, but the reality is it's your equity that's gonna pay and take into account the accumulated mortgage.
How can my equity come
Because
into
your
the picture?
principal balance is growing. So say we start with 500,000, okay, and that's something that you wanna keep in mind. If we start with 500,000 and we calculate that your monthly payment's gonna be 2,500, principal and interest,
Right.
that's being added to the 500,000 every month. So your
Added to the
mortgage,
500,000?
your mortgage grows, yes. So instead of it being a forward paying where you're decreasing your mortgage, it's a reverse mortgage and you're increasing your mortgage. So it would go 500,000, it would be 5,025 month one, 505 month two, and increase accordingly as you go.
But she will get the 2,500 every month.
She will not get 2,500, it's added to her principal balance. There's two things with a
Oh,
reverse
you pay
mortgage
by
that,
yourself, okay.
yeah, there's two things that you can choose from in a reverse mortgage, or you can choose on both. You can create your mortgage and know that you have a home mortgage accumulating there that you're not having to pay monthly. And in addition to that, if there's enough equity in there, you can also request a line of credit. That line of credit sits there, and it's always my recommendation to people, unless you need that money, do not extract it every month, because that's part of your equity. So if you don't need it every month, don't take it. Take what you need when you need it.
How much will be the line of credit? that
It
you'll
depends
get?
on the equity that you have. And we also tell you that in your proposal. We give you the option of just the straight mortgage. And if there's enough equity in there to acquire a line of credit in addition to that, we offer that to you as well.
And I don't have to sell my property before buying the upgraded one, correct?
No, you would, because you need the money
Oh.
to put toward the
No,
home.
if I have the money.
Oh, if you already have the money,
Yeah,
then no,
then-
no.
Then you cannot touch my.
No, we don't,
property that
nothing
you
is
gave
ever tagged on to your other properties that you own. Yeah, and that's part of the process that we have. It's not just talking to me, it's also taking a counseling course. You can either do it by phone or in person, and you actually speak to a third party who speaks to answer more of your questions that you might have, and also making sure that it's a good thing for you and that you understand it very clearly and how it works.
Question, what happens, say, a married couple, husband passes away, because we always pass away first. You know,
Yeah.
and the wives outlive us.
Suspicious, huh?
Yeah, suspicious, I know. My wife knows I'm allergic to some stuff, so I consider my soup every day, my coffee every day. But, so say husband dies, what happens with, the wife, with the reverse mortgage?
Actually, you'll hear stories from friends from back in the old days. If the wife was under 62 years old and the husband was 62 when the reverse mortgage was acquired, the wife would have to move out. That was changed several years ago, and that is no longer the case. A younger wife is always grandfathered. The spouse will continue living in there. It's not considered something that husband dies, so now you can't afford it. That is not the expectation, that is not the understanding. Both of you qualified for the reverse mortgage together, you will continue to remain in the home, and you will not be asked to move out.
One of the bigger concerns that I get from, I'll use my parents for instance, as one of my parents' big concerns, oh, well, you know, I wanna leave a house for you guys, and, you know, when we both die,
You wanna leave something
I wanna
for
leave
you
something
guys.
for you. My response to my dad was, well, I'm just gonna sell everything that you give me, so, what if there are legit concerns about, hey, I just wanna leave a house for my children, but I have this reverse mortgage, what about then?
Okay, so we'll touch on a few things where that's concerned, because many of our parents, they have that in their head, that they have worked very hard over the years to acquire their real estate, and then they're really considering this reverse mortgage because they're in a tight spot, and they don't wanna have to make that payment, but they wanna live comfortably. But then my children, what will we leave for our children? The reality is that if you ask your kids and you include them in this consideration and they join the conversation, they're gonna tell you what Miguel says. It doesn't matter. The more importantly, the most important thing to us as your children is that you continue to live comfortably and you're happy, that you're not suffering, that you're not climbing the second story and possibly falling, that you're keeping it to yourself, that you can't make the monthly payments because you're thinking in the back of your head that you have to leave this for your kids, and you're struggling. The last thing any of us kids wants for our parents is for them to struggle in their retirement age. We want them to be happy, we want them to be healthy, and we don't want them to have to worry about it. Our parents have done their job with regard to raising us, providing for us, and everything else. And at the end of the day, as probably when you talk to your children about it, they're gonna tell you, you know, I'd much rather have you happy, healthy, and not having to worry about struggling every month to maintain a mortgage and only be left with $25 a month to cover groceries. No, that's, include your children in this conversation, and always know that more often than not, they're gonna support you 100% if it's something that benefits you. If it's something that benefits you.
Last question for me.
Yes, please.
Do it. So, both parents pass away, how long do the kids have to refinance, or are they forced to refinance? Do they have to sell the property? What are their options?
Okay, let's say last parent passes in January. The children will notify the bank that the parent has passed. Bank will tell them you have 6 months to make a decision. Do you want to sell the property? Are you planning on refinancing out of this reverse mortgage and keeping it for yourselves? That would be your other option. Those are basically your two choices. Say the kids are not quite sure what to do, they're exploring different possibilities and options, and they're nearing the 6-month mark. Now what's gonna happen, is the bank gonna take the house? No. Pick up the phone, call them and say, we're still trying to figure out how we're gonna do this and we're not quite ready yet. Can we get an extension? They give you another extension, so you have up to a year to settle up with the bank.
And during that year, do they have to make payments?
No, it's still accumulating like it normally would in the equity.
Unlike
So-
a forward mortgage where they would have to.
Correct. You are not your children are not taking on that burden of an additional mortgage. Yes,
So
ma'am?
they can sell the house, and if it's worth more, then they will get money for them, they pay off and then.
Yeah. So just like if you were to refinance your home today and you were gonna get a regular mortgage, in refinancing your home, we have to verify with the existing lender how much you owe. That is what's paid off. That's it. Everything over and above goes to the children. Yeah.
And we're gonna hang out here for more Q&A with Juliet, and we'll bring up our next speaker. But any more questions? No?
They may come after. I have
Yeah.
They will.
some info for you.
So that's
Later.
really good examples of reverse mortgage. I'll give you two. I had a couple in their 80s, the early 80s, who called me because they wanted to sell their house and they couldn't afford their payments any longer. They had a traditional mortgage. They were in their 80s. The Great Recession really took out all of their retirement funds. So really, they were just living off of the gentleman's VA pension, and that's really all, and Social Security. So they didn't have much, but they had bought this house many years ago. They had refied, and they still owed money on it. They called me, Miguel, please sell our house. And I asked them, well, what? I asked their income. Well, they're not going to qualify for much to purchase. So I asked, well, what are your plans? And they said, well, we're going to sell the house and we're going to buy a mobile home. Okay, well, how much is the mobile home going to cost you? $25,000. Okay. Do you know that you still have to pay lot fees? You know, those run about $600 depending on the, you know, if you have a luxury, you know, trailer park or, you know, with the pool and the clubhouse, it could be more. Oh, I didn't know about that. Well, how much money do you think you're gonna get from this equity from this property? I did the numbers, heavily discounted my commission. They were only gonna come out with $50,000. I thought, well, you're gonna spend $25,000 to purchase the mobile home and $600 a month. That's $7,200 a year. How soon do you think you're going to spend this $50,000? It's not gonna last. How much longer do you think you're gonna live? So we had to come to Jesus talk. I said, you know what? I'm not gonna sell your house. Now, granted, I'm a realtor, that's how I make money, but I'm not in it for that only. So I referred him over to a reverse mortgage specialist. This was a few years ago. Got him into a reverse mortgage, paid off their existing loan. They had no payments whatsoever to make anymore. So now their pension and their Social Security combined was a lot more money for them because they weren't making their mortgage payment any longer. So 3 years later, the gentleman passes away. She stays with the house with just seamless transition. She keeps the house, and she's able to keep going. 3 years after, she called and I'm okay, I'm ready to sell, I can't live here any longer, I need to go into assisted living. Sold her house. At this point, the equity had grown as well, the equity had grown. The mortgage balance had grown a little bit too, but the equity had grown. So where I initially met them 6 years earlier, and they were only gonna make $50,000, she made $175,000. We did some tax planning around it for her as well, so she can keep the VA benefits and be in assisted living. She made $175,000. For one thing that she told me was like, thank you so much for getting me into the reverse mortgage. During these last 6 years, I've been able to help my granddaughter with her college because I had extra money and I could help her with the textbooks. So that's a good example of how it could really save someone who not necessarily made bad decisions in financial planning, but that maybe economic variables really destroyed their retirement. So that's one. The other one, which I like to tell, is I had a couple, Dan and Artie, one of my favorite couples. They're in their 70s, early 70s. They love to travel. They've paid off their house, big house. Their kids are in their 40s. They live out of state, and they live alone in a 5-bedroom, 3,000 square foot home with a pool, lots of maintenance. They're tired. They're gone for months out of the year, and they have to pay someone to come and take care of the house, et cetera, et cetera. What we did for them is we actually sold their house. It was paid off, sold their house, moved all their equity. They got a reverse mortgage just because they didn't want to spend all their equity on their next purchase. They downsized, so they went from a 5-bedroom home in Terra Nova to a 2-bedroom condo in Little Italy. Now they're living the lifestyle. In Little Italy, all the restaurants, et cetera, they have a slight reverse mortgage, no payments. But we coupled not only a reverse mortgage, but we used Prop 60 to help them take their assessment, their tax assessment with them from their Terra Nova home, which they bought in the 80s. So they were paying about $1,700 a year in property taxes. They took their property tax assessment with them to their $600,000, close to $600,000 condo in Little Italy, took their property taxes with them at $1,700. They would have been paying $7,000 in property taxes a year if they had not used Prop 60. So yes, ma'am.
I'm also here for the Prop 60 and
Good.
Prop 90.
Yes,
How it will affect my current.
absolutely. So
Taxes.
Prop 60.
With the bill.
Yes.
The bill by Trump.
Yeah, well, and then you're gonna find out about that, and there's a new measure that's a petition for California. So Prop 60 and Prop 90 are California initiatives, so they apply to California. California passed these two propositions, 60 and 90, to be able to sell your home and then take your assessment with you, which is what we did for Dan and Artie. This is why they were able to save so much in property taxes. Prop 60 is for intra-county, so within whatever county you live in, then you're able to transfer your taxes. So if, say where do you currently live? You live in Otay Ranch. So say you sell your home in Otay Ranch and you decide you wanted to move to, I don't know, La Jolla, per se, or anywhere in San Diego County, then Prop 60 is what you would use. There's an application that you would fill out, which we can discuss after the seminar. It's a simple application with the County of San Diego stating that you're transferring tax bases from Otay Ranch to El Cajon, La Mesa, or even Otay Ranch to East Lake, as long as it's your primary residence.
How will it impact the rate on the taxes if I were to do that?
On your property taxes or your?
Correct.
Yeah, your property
On my
taxes?
property taxes.
It keeps them the same. So you take your assessment with you. Here's the catch though. The purchase has to be equal or lesser
Aha.
amount,
Yeah.
okay? So what that means is that if you sell a home for $600,000, you have
It
to buy,
should be
you have to buy something at
or-
600 or below.
Yeah, below.
Okay? Now, Prop 90 is inter-county. So say you're moving from San Diego County to LA County, then you would fill out a different application. It's an application that allows for inter-county tax assessment transfers. Here's a catch with Prop 90. Currently only 12 counties accept the intra-county transfer of tax bases. What that means is that not every county that you're planning to move to is going to accept your current assessment of value.
So they could raise it,
They could say, sorry,
yeah.
I'm not gonna accept it, we're gonna tax you at current market value.
So that's under the state of California.
State of California. So what we need to do in that case, if you're planning to relocate from San Diego County to any other county in the state of California, we need to verify which county you're moving to and what the likelihood of that county accepting a tax assessment transfer. However, there's a new petition for California to make it universal for all of California. So you'll see it, and we'll send you the link via email if you register to be able to sign the petition. What this petition is the aim of this petition is to make universal transfers of assessments for persons 55 and older who sell. That's a catch fee. You have to be 55. It has to be your primary residence, and you're moving from anywhere in the state of California. Now, here's a really interesting thing. So currently, both for Prop 60 and Prop 90, you have to buy at the same or lesser value of your property tax assessment or market value, right? The new proposed law that we want to put into place is to have a tiered value. So now you could buy, say you sell your home at $600,000 and you want to buy that $1 million house, you could take your $600,000 assessment with you, and anything above $6,000 or $600,000 would be taxed at a different tier. It'll be a pro rata
Based on,
based on the market value on whatever the county that you move to assesses your home. So it'll be prorated. That's a huge benefit for many individuals who want to move from one county to another, say to be closer to the children. We've had a lot of reloads from San Diego to Ventura, Orange County, where some of the properties are more expensive, and now you can take your San Diego tax or all of your tax assessment with you, and then move it to Ventura County, and then have a tiered system. The law hasn't passed yet, so currently we only have Prop 60 and Prop 90. Okay, Prop 60 is if you're gonna move from San Diego, inside of San Diego, and Prop 90 from San Diego to another county in California. And again, it's only 12 counties in the state of California that allow this inter-county tax assessment transfer.
what's this idea that because of the impact on the new bill under Trump, that the interest on the rental properties is no longer deductible from.
Well, that's a perfect segue to bring up Nuri. So I'm gonna bring up Nuri.
Right.
Are you ready, Nuri?
Yeah.
Yeah, I'm bringing up Nuri. So Nuri is a tax professional here.
Okay.
And she,
You're the person
yes,
like
she's,
Okay.
yeah, she has 20 plus years of experience. She has now what, 7 offices?
7 offices.
7 offices that throughout the county and in Tijuana. So she does.
Company.
H&R Block.
Coffee?
H&R.
I'll go ahead and
Yeah.
do some.
Yeah.
All right.
We own a franchise of H&R Block.
I see.
So without further ado, she's going to talk about all those impacts, and we're still learning.
Yeah.
We're still learning
We're
what
still
these
learning,
are, but there's a lot of
absolutely.
changes. So there you go. Thank you.
so much, thank you. Well, thank you, welcome all of you. So my name is Nuri Sainz. I'm an accountant, I'm an enrolled agent, tax professional. And just to, add a little bit about what we have in terms of the locations that Miguel was talking about is, we own a franchise of H&R Block. So we don't work for corporate, we don't work for the IRS. So you guys, I live within the city, so it really gives me the opportunity to make a connection with, the homeowners, the business owners, to talk about the reality of taxes, especially with so many changes that we're facing for 2018. We'll talk about it in a minute. And how all these questions about my property taxes, and you'll be able to see why be able to keep your property taxes lower would really help, because for the other part of the population that we pay a lot more for property taxes, that we don't have the opportunity, will be limited to how much we can take as a deduction on our personal taxes. So we'll get to that in a couple of minutes. So again, my name is Nuri Sainz. There was a picture there.
I don't know what happened.
Yeah.
Yeah, I don't know what happened. I thought so too. My computer's not playing nice. Not playing nice.
That's kind of weird. Okay. We've been in business for 20 years. Funny story, when I started going on accounting school, I always thought that my dream job was gonna be work for the IRS. True story. I thought I was gonna be the best IRS agent out there. You know, I'm glad that I didn't apply. I really like to be, I love to be on the other side of the equation.
Yes.
And now I deal with the IRS a lot, but now representing the clients, helping the clients be in compliance, or just understanding, you know, that changes on all the regulations and tax law, which is, as we all know, could get really complicated. My office does accounting, bookkeeping, payroll services for local business owners, and all kind of business services in terms of, sometimes even just to get a business license, especially for, you know, the people that they want to start business at home, work from my garage, is it really a business, do I need a business license? A lot of those little details are always good to know that you have someone locally to answer those questions for you. So I'm gonna focus on changes, we call it tax reforms, I'm sure we all heard about that, for 2018. And I'm gonna focus on the individual level. There's so much to learn still out there. Like I said the other day that, you know, the 1,100 or 1,200 pages, I'm not done reading those yet. So I'm gonna share as much as we know now, and there's so much to learn for, you know, this year before obviously the year is over, so we can help our clients. And a lot more to learn about businesses, but I'm gonna focus on the individual level. So, you know, in a couple of years, we're gonna be talking about what we used to do, what we used to have in terms of our taxes. So it will be a little bit of history in a couple of years. Obviously, the tax reform impacts everyone, and it could be different for each one of us. So we'll talk about it in a minute. It will all depend on my family status. You know, am I single, married, filing jointly, head of household? Do I have kids that I can still claim? And this might not apply to you, but this is how you can impress your kids, your children, and your grandkids, that now I know a little bit more about the tax reform, especially if they have kids under 17. Even worse, if they don't have kids under 17. We'll talk about it. Your income is also very important in terms of how much will these changes affect me on my taxes. Please choose a tax professional, and it doesn't have to be me. I have a lot of respect for all the trusted professionals in town. Talk to them about is this something that I should worry about it? And we might retire, but we might have rental properties. We might have, you know, a second property that I might thinking to sell, refinance, get a loan. How is this gonna affect my taxes in the future? So this is the perfect time to have a conversation with a tax professional. Even though it's for 2018, right now is when we have to talk about it. Tax reform will impact most of taxpayers, individual taxpayers, and business will be affected as well. And again, I'm not gonna talk about business today because there's so much to talk, but individuals for sure. Tax bracket, okay, something that we can all say, and we'll get to that in a minute, we'll say that it could be a good thing. Your personal independent exemptions as well, your child tax credit, and we're gonna talk about standard deduction. This is a big one for us in California. This is where we have to keep an eye of, you know, why we used to be able to take at the federal level, as a deduction at the federal level, but it's affecting us because we're in California. Totally different than Texas or other states that they don't have estate taxes. I had a conversation with this couple. They have a really good friends that they live in Texas, and they fight with us all the time because they think we in California, we Californians, they say, we pay less federal taxes, less than them, because we have bigger deductions than they do, because they don't have estate taxes and they don't have to take that in consideration with the, you know, their federal tax return. We always fight about it, always. So they're happy. They told me the other day, now you know how it feels, okay? And I mean, it's fascinating how where we're located could have a different impact on our taxes. Healthcare, we'll talk about that as well. So, the tax reform, we also gonna hear this a lot, is, Tax Cuts and Jobs Act. That's basically what, you're gonna hear a lot when we're referring about the tax reform. My tax bracket. So, before the tax reform, I used to have a 10, all the way, the lowest one was 10%. At the individual level, 39.6%, the highest one. I do have some clients that they're happy to go from 39.6 to 37%. Even if it's only 2%, 2.6, they're happy. For a lot of them, it does make a big difference, especially when they have investment income. They have a lot of rental properties that they have a lot of cash flow, right? And they have, some of them, 3 retirements, military, regular federal job, you know, and some of them, they getting Social Security benefits or any other job that they did. So not because, you know, we know some of the taxpayers are retired, doesn't mean that they don't have taxable income.
How do you get to TCJA
Oh, tax,
versus pre?
oh, this is before the tax cut,
Yeah, and
adjustment? Yeah,
And then.
and this is now 2018.
Oh,
this is-
that's the 2018.
This is
It
2018,
has gone down?
exactly.
Ah.
Yeah, so right now we're gonna be filing our 2017 taxes, will be this one still,
Yeah.
and then next year will be
Okay.
this.
That's why I paid for all the 2017, December
Correct.
29 deadline.
Exactly.
So now I'm getting the
Right now,
the
this is
2018.
what's happening
So
today.
that's kind of smart of me to do that.
Well, you need
In
to
a way.
plan, and then to plan ahead, right? Because you
Yeah.
know what's gonna happen
Yes.
at the end of the
Oh,
year.
okay, so
Right now is
it
when
went
you
down.
should be planning, exactly.
Okay.
Because this one's gone. I mean, this one, yes, you're gonna file the taxes, but it's gone, right? This is what's happening now. Your personal and dependent exemption, so if you still have a dependent that you claim on your tax return, those are eliminated. So, and that's including our own personal exemption. So, if you could picture your tax return, the first page, it says, I'm single or I'm married, and I'm claiming 2 exemptions, my husband and myself, or just myself, right? And I was able to deduct 2017 and prior, I was able to deduct $4,000 per each. I think it's $450 for $4,050 for 2017. $4,000 per person was my deduction. Meaning if my income, I'm gonna use easy numbers, if my income was $20,000 and it's 2 personal exemptions on the return, my husband and myself, I was able to deduct $8,000 before I get to my taxable income. Those $4,000 are done, okay? But, okay, it sounds like a really bad thing, okay? But I'm gonna jump into the next one. Sorry, here, I'm gonna go through this one. But my standard deduction, it's going up, okay? So to compensate that I'm losing my personal exemption value of $4,000, I'm getting an additional amount of a standard deduction. So if I don't own a house, if I don't itemize, okay, if I was single, my standard deduction was $6,350, now it's gonna be $12,000. If it was a married couple, my standard deduction for 2017 was $12,700, now it's gonna be $24,000. Sweet, I don't have to do anything. I can have the house that I have with lower amount of property taxes that probably before 2017 or prior, I didn't used to, I didn't use that amount to itemize anyways, but now I'm getting an additional deduction. So this one is actually what compensates the loss of the personal exemption. So even though a lot of people are scared, like, what do you mean I'm gonna lose my personal, exemption for me and my 1 kid or 2 kids? Yeah, but you're gonna get a higher standard deduction.
Is it also true for itemized deduction? Because that's standard.
Okay, so Here's, I like you already, okay? Here,
Well, I'm in business.
no,
I-
oh, no, and this is me, my perfect example, we itemize, right?
Yeah.
Because my property taxes are probably $12,000 or $12,000 a year, okay? My, estate tax, California taxes that I would see, withholdings or estimated payments, I include those as well. I said, I don't know, another $3,000, $4,000, $5,000. My shareable contributions, right? All my donations, my DMV fees, my health, health-related expenses, if I was able to use that, all those little things, it was more than $24,000.
Is it still deductible?
Yes, it is,
But,
but
see,
we're gonna talk
No,
just for California, okay? Just for California.
for donations,
No, donations, actually, we're gonna get to that, they're going up, so that's a good thing. But my property taxes and estate taxes are limited to $10,000, that's it. That's it,
Wow.
I know. So this is where my friends from Texas are laughing now, okay, of us, because they're like, you see, now you're probably not gonna have enough to itemize, and you're gonna go for your standard deduction of $24,000 or 18 or 12. Because you might not have enough, because now we have a limitation of $10,000. So going for a reverse mortgage right now makes a lot of sense, because I might not be able to use it anyways, right? Might as well have somebody else do the payment for me, right? Can we all agree on that?
Heck yeah.
Absolutely, yeah. And having lower property taxes is the perfect way to go. I wish I could use the Prop 60 or
You're
60.
too young.
I know,
60/90.
60/90, right? My clients that they used to have Prop 13, and they were like, oh my God, I'm not able to move to, from this old house, right? They could have other options now, which is great. And forget about itemized. Forget about itemized. Just go for your, for your standard deduction. Again, it's all about tax planning now for 2018, and make those decisions, because I might not be able to use it. I personally might have just a little bit more than 24,000. And that's true if I could do probably more donations, charitable contribution, that will help a little bit more, right? Because state taxes in general, property taxes and state taxes, I only have $10,000 to use. This is where, as in California, the tax planning has a lot to do with my decision of what to do.
I have a question about that $10,000 limit on property taxes. Is that just for the owner-occupied property, or would that apply to investment properties?
For the owner-occupied property, yeah. So your investment properties, you still have an income to report, right? It's your rental properties, and you have all the expenses to take in consideration. That doesn't change. Actually, those people that they have now a lot of investment properties, and they have a house, what they're thinking about, like, maybe now is the right time to buy a different house at the lower price. The 2-bedroom, 1 bath that we were talking about, now it makes a lot of sense. And this one, that it cost me a lot to maintain, could be a rental property, and then I get the write-off. Again, somebody else will be paying for my house. See how all this, even though they say that the tax reform is to simplify taxes, it's not true. It's not true. And then they're talking about just a postcard. Yeah, that will be the front page of the return, but to get to line 2, to line 3, to line 17, it's a lot of work to do. But even better than that, again, this is punching numbers on a tax return, is the tax planning. Wait a minute, what do I do with that property, right? That it was my main home, that I have a limitation. Perhaps now I want to have a conversation with Miguel, I want to have a conversation with Joel about what do I do. This is what's fascinating about the tax reform. because people really had to think about how do I do this. And it's not an easy decision, it's not an easy decision because as you're learning this, you're making decisions in terms of, what to do with this property, especially for those that, it's been my house for I don't know how many years. It was for my kids. Forget the kids. They have other things to worry as well.
That's right.
I'm serious, yeah, they have other things to worry. I'm gonna go back to the personal exceptions. They have things to worry, because now my kid that is in college, it's worth zero. It's not under 17, and he's in college, and some of, us at one point have two in college that they're costing us, okay? If it's under 17, I might get $1,000 for 2017, and now I might get up to $2,000, okay? Under 17, but if the kids are in college, I'm not getting anything, okay? So, there added this non-refundable credit, family credit we call it, $500. So if I'm filing my return and all I have is one dependent and my dependent is 22 years old, okay? I don't qualify for the personal exemption anymore. We don't take, those are eliminated. I don't qualify for itemized deductions. Perhaps I'm gonna go for the standard deduction. Okay, let's say I'm paying a household, I'm gonna go for this one, right? This is my only option. I don't qualify for the child tax credit, and all I'm getting is a non-refundable $500 credit. Non-refundable, meaning it only goes against my tax liability. I don't get it back. I know, I was like, okay. Part of the itemized deductions that they were eliminated is employee business expenses. We're happy it doesn't apply to all you. Again, great conversation with kids and grandkids. I know about this, right?
Including mileage.
One of the ladies on another meeting, she is, I don't remember what she does for a living, but she used to take advantage of mileage because of work, okay? Meaning the employer, she does have an employer.
How about for volunteer work?
Volunteer?
Like if you're a board member of a nonprofit organization.
Volunteer is still good
Uh-huh.
if you're able to itemize.
Oh, of course.
If you're, of course, that was the same rule like before, so that's still shareable, it's considered shareable. But let's say I have my employer, I work for McDonald's, and let's say I'm a branch manager or area manager, and I go visit this location, this other location, and I had to use my own vehicle, and I don't get reimbursed for that. I used to be able to utilize mileage as a deduction. Those are gone. So a lot of meetings were with their employer or bosses about now who's gonna pay for that? Who's gonna pay for that? So this is where businesses probably, they're gonna change their mentality in a lot of these areas and decide, you know what, sure, you're gonna get reimbursed because it's a deduction for me, it's not for you, you're happy, you're a good employee, hopefully we'll change, that mentality in terms of how we do business. The use of my house for business, that's it, nothing, eliminated, okay? So, if you really have to work, either again, go to the office again, have the employer have a little desk for me, or I don't get the deduction. So again, it will change the mentality. What could happen as well is that a lot of people are not gonna say, well, I'm gonna start my own little business now. Now I can work from home, and now I can utilize my mileage, just like any old Uber driver, like any other landscaping company, one person. So see how this could trigger the change of mentality, not only for the employer, for the employee as well.
So if you own your own business, you can still make that deductions, right?
Okay. And that's what we're gonna see. Even the people that they were hesitating, the people that they were thinking about it, now they're gonna go for it. And you can do it from home.
Yeah, oh, that's good.
You know, you can do it from home. Now you can get the deduction that otherwise, you know, was gone. This is the $10,000 limitation. It's called SALT. For real. This is it. It is on the tax reform.
Pour salt on my wound.
I know, the state and local taxes. So now you're here, you know, we're in the, you know, business, the industry, community, we heard like, well, you know, if we're one of the SALT states, this is why we have to, you know, deal with that, right? So, $10,000 limitation. Again, great opportunity. If my house is costing me way too much, either I go for reverse mortgage, either I convert that as a rental, or I sell it, cash out, especially if it's your house, or been your house for, you know, years and years. Cash as the equity, buy something smaller, so you don't have to worry about this, so you don't have the limitation, and enjoy the equity that you have, or have somebody else pay for the other house. Home mortgage interest, limited to a loan of $750,000 on one loan. I think we still have a few around the area of $1 million or more. We still have a few, but I think a lot of people are close to the 750, perhaps a little lower. And it could be an incentive for a lot of people to lower their principal amount so they can still qualify to write off the interest on. But in some areas, $1,000 loan is nothing. You know, so again, things that when you're buying, now not only, okay, do I qualify for this one? I don't wanna be over $750,000. Charitable contribution, this is a good one for a lot of us that would like to, you know, contribute to local organizations. Up to 60% will be deductible of your, you know, 60% of your AGI. Before, has always been for years and years and years. I think 1986 was the last tax reform, 50% of your AGI. Now,
What is AGI?
adjusted gross income, so
Excuse me?
adjusted gross
Adjusted,
income.
oh, for the adjusted, okay,
Exactly.
gross.
Yeah, so
Okay.
your adjusted gross income, you have all your income,
Okay.
a couple of adjustments, and then you get to your adjusted gross income. 60% of that,
That's good.
I have one of my clients that he's always, I don't know how he does it, I mean, he's definitely a better person than I am. But he always, the amount of contribution that he does, they're so close to his 50%, of the 50% of his income, which is, I mean, it's like, wow. And we have a lot of people that, you know, they like to support the community, local community of nonprofits, and this is a big one for a lot of them, because now I can do that.
So, do you mean that, you don't deduct or tax shelter 100% of the AGI?
On
You know, I had that impression that
on
you
charitable
had.
contributions,
Yeah,
you
right.
don't, you carry over the rest for future years. So if my income is $50,000
Yeah.
and I make a donation of $30,000,
Right.
I'm only gonna be able to take this year 25,000.
Oh, you don't?
Yeah. And then the rest will stay there for future years. I'm gonna carry over the rest from it. So it's not that I'm losing the deduction, I'm just not gonna be able to use it this year.
Oh,
So it will be for future years. Medical expenses, we used to have subject to 7.5% of, again, of our AGI. It went up to 10%, and now it's going down again to 7.5% for a couple of years, 17 and 18, and then again in 2019. I don't wanna say that I really don't worry about medical expenses deduction, because most people are not
Yeah.
able to get, so
No.
don't pay a lot.
No.
Yeah, this one is like, okay, whatever. I mean, they're just, and this is where I really wanna hear from you. Okay, so, this could be good news and could be not, okay, for a lot of people. So the penalty for not having medical insurance, you know, whether it's through Cover California in this case, or Medicare, if we're not there yet. So right now, taxpayers are facing a penalty for not having insurance. So if I don't have an employer that provides health insurance for me, I had to find my own. And if I don't do that, based on my income, I have a penalty. This is gonna change in 2019. It goes back to what it was before, like you don't have a health insurance, you deal with your own medical bills somehow.
Why not in 2018? How come 2019?
I asked the same question, okay? And all I can say is part of the give and take that happens at the Congress level, is this.
I interject. It's because the insurance companies have to file their rates 8 months ahead of the year, and they've already accounted for the health insurance taxes within the.
That's what we have, you know, an expert on health insurance policies, and that. Thank you, there you go, it makes perfect sense now.
They paid already the doctors. That's what it is.
Sorry, Congress, I was.
We'll still blame them.
I'm sorry, sorry.
We're still blaming
I
Congress.
blame on them, but
There's
that's
still plenty
just. So, again, this could be good news for a lot of taxpayers. Again,
It is, but
especially the one that we are running our own business, right? I don't have an employer that is providing. It could be, especially if it's a little business,
It's a
myself,
penalty.
you know, it could be a good news. For other people, could be like, oh, I never have insurance before, no big deal. What I really was hoping to see is that with these changes, that the premiums will go down. But that's me and my perfect world, right? But no, they're gonna go up, right? They're definitely gonna go up.
It's okay, but they don't have to squeeze their neck on it.
Exactly. Again, talk to your tax professional, ask for help, do some planning, talk, you know, with your kids and grandkids about some tax planning, because this is the perfect time right now before the year is over to do some tax planning. Thank you.
Thank you. Well, as promised, we're gonna keep this brief, let you guys get back to your weekend. But if you have any questions, we're gonna be hanging out for any specific itemized, I know you have a lot of questions, hang out, please. We'll be here as long as you want us to. Reverse mortgage, taxes, Prop 60, Prop 90. But we also have a special guest here too. Jim is a specialist in Medicare, Medi-Cal insurance, health insurance benefits, Affordable Care Act, etc. If you have any questions about that, Jim can answer those as well. So feel free to hang out. We got plenty of coffee, plenty of pastries left, so hang out. Thank you.